Have you ever watched a stock suddenly explode upward, making early investors rich overnight, while you sat on the sidelines wondering how you missed the signs? That sinking feeling in your stomach when you realize you could have been on that rocket ship if only you had seen what was coming. You're not alone. The stock market is perhaps the world's most sophisticated psychological battlefield, designed to keep the majority of traders always one step behind the smart money. But what if you could change that? What if you could learn to spot those breakouts before they happen, positioning yourself alongside the market masters instead of chasing after them? That's exactly what legendary market technician Richard Wyckoff mastered over a century ago, and his methods remain shockingly effective today. You see, the market never announces its intentions with fanfare or warning. It doesn't send you an alert saying, "Major breakout coming tomorrow at 10 a.m. Instead, it sits quietly disguising its true intentions behind seemingly random price movements that confuse and mislead the average investor. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world, and if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Has this ever happened to you? You see a stock moving sideways for weeks, looking completely dormant. You consider buying but decide to wait for more confirmation. Then suddenly it rockets up 20% in 2 days, and you're left watching a move that could have transformed your portfolio. The real question is, were there subtle clues you missed? The answer is almost always yes. Wyckoff discovered that true wealth in the markets comes not from guessing or gambling, but from developing an almost sixth sense for when the tide is about to change. It's about learning to read the subtle footprints that big money leaves behind as they quietly accumulate positions before a major move. These aren't random patterns. They're deliberate actions that, once you understand them, become as clear as day. What you're about to discover might surprise you. The market constantly whispers its intentions to those trained to listen, while the crowd focuses on headlines and hot tips, missing the real story playing out on their charts. The professional sees something entirely different. They see the invisible hand of accumulation, the rising floors of support, the subtle shifts in volume that signal something big is brewing beneath the surface. Stay with me until the end of this series, because the 7 secrets I'm about to share with you transformed how I view market action forever. And they might just be the missing piece you've been searching for to finally get ahead of those explosive breakouts instead of chasing them. The difference between average returns and life-changing profits often comes down to this one skill: spotting the breakout before it happens. So what exactly are these telltale signs that Wyckoff identified, and how can you train yourself to see them? If you're serious about spotting breakouts before the crowd, hit that subscribe button to join our community of traders who see what others miss. The first revelation in Wyckoff's approach is understanding that the market has an almost devious way of testing your resolve. Think of it as a psychological battlefield where your biggest enemy isn't other traders. It's your own impatience. The market deliberately creates false signals, sudden drops, and misleading rallies specifically designed to shake you out of good positions or lure you into bad ones at precisely the wrong moment. This hidden truth transforms how we interpret price movements. What looks like random noise to the untrained eye is actually a sophisticated language. Every feint, every pause, every seemingly insignificant bounce is communicating something important about the underlying journey of accumulation or distribution happening beneath the surface. Most traders fail not because they lack information, but because they lack the patience to let their trading thesis unfold. It's a mindset shift that separates professionals from amateurs. While the crowd chases every wiggle on the chart, the disciplined trader waits for those rare moments when all the evidence aligns. They're comfortable, sitting in silence while others frantically jump in and out of positions. But here's what fascinates me most about Wyckoff's insights. Those explosive breakouts that seem to come out of nowhere. They almost always follow periods of apparent inactivity. It's counterintuitive to our natural desire for constant action. But the biggest moves often develop after a stock has been quietly moving sideways, seemingly doing nothing interesting at all. This consolidation phase is where the real, behind-the-scenes drama unfolds. While price moves sideways in a narrow range, barely grabbing anyone's attention, a profound power shift is taking place. Ownership is steadily transferring from weak, impatient hands to strong, conviction-based investors who understand the stock's true value. Think of it like a spring coiling tighter and tighter. Each day the stock refuses to break down, despite opportunities to do so, is another turn of that coil. The longer and tighter this consolidation, the more powerful the eventual breakout tends to be. It's during these quiet periods that amateur investors grow bored and sell out, missing the transformation about to occur. What makes this particularly revelatory is how it contradicts everything we're conditioned to seek in markets. Our brains are wired to chase excitement, to look for stocks making big moves right now. But Wyckoff discovered that the real opportunity lies in spotting stocks that appear to be doing nothing special, yet showing subtle signs of accumulation beneath their calm surface. Now I want to go even deeper into precisely what these subtle signs look like, because recognizing them will completely change how you evaluate potential breakout candidates. But before we continue, I'm curious. Has impatience ever caused you to miss a big market move? Write "patience tested" in the comments if you've experienced this frustrating aspect of the trading journey. One of the most enlightening revelations in Wyckoff's approach is understanding the market's deceptive nature. This isn't just about price patterns, it's about decoding the psychological warfare happening on your screen every day. The market has perfected the art of deception over centuries, showing just enough of its hand to create false hope before yanking it away. Think about your own trading journey for a moment. Have you ever spotted what looked like a perfect breakout, jumped in with excitement, only to watch the stock immediately reverse and drift lower? Then, after you've sold in frustration, witnessed that same stock launch into the move you originally anticipated without you on board. This painful cycle isn't random, it's by design. This illusion of opportunity, followed by disappointment, is the market's most effective filtering mechanism. It's the hidden truth behind why so few succeed where many fail. The market deliberately creates these false signals to separate emotional traders from their capital before the genuine move begins. It's a brutal but effective ritual that keeps the rewards flowing to those who understand the game beneath the game. But here's the transformative insight Wyckoff discovered. Real breakouts speak a different language entirely. They don't whisper, they announce themselves with unmistakable authority. When genuine conviction enters the market, the character of price movement fundamentally changes. The stock doesn't just poke its head above resistance and hope for the best, it surges through with decisive force. Volume swells dramatically. Price gaps upward and keeps climbing. Pullbacks are shallow and short-lived. There's an almost magnetic quality to the movement, as if the stock is being pulled upward by an invisible force. This isn't random price action. It's the footprint of institutional money flowing in with conviction. The profound wisdom here lies in learning to distinguish between the market's head fakes and its moments of genuine commitment. Most traders never develop this discernment. They treat every move above resistance as equally meaningful, when in reality, the texture and character of the breakout reveal everything about its authenticity. This perspective shift can revolutionize your results. Instead of jumping at the first hint of upward movement, you wait for the full evidence suite, the powerful thrust through resistance, the expanding volume signature, the refusal to give back gains. You're looking for the stock that doesn't just suggest it wants to go higher. It demands to be taken seriously. The market's deceptive nature hasn't changed since Wyckoff's era, but neither has the unmistakable signature of genuine institutional commitment. Learning to read these signals transforms not just your trading results, but your entire relationship with market psychology. The clarity that comes from truly understanding this dynamic is profoundly liberating. I'm curious about your experiences with false breakouts. Has a stock ever tricked you with what looked like a perfect setup only to reverse on you? Type "false signal burned me" in the comments if you've lived through this particular market lesson. The unmistakable signature of a genuine breakout is its decisiveness. This revelation completely transformed my understanding of market behavior. When I was starting out, I'd often wonder why some breakouts would immediately fizzle while others would launch into powerful trends that seemed to have no ceiling. The difference wasn't luck, it was the invisible hand of institutional conviction working behind the scenes. What Wyckoff discovered, and what remains true today, is that when smart money makes its move, there's a remarkable clarity to the price action. The stock doesn't cautiously edge above resistance, it vaults over it with authority. There's no hesitation, no second guessing. The tape suddenly comes alive with activity as orders flood in, creating a momentum that feels almost unstoppable. This decisive action stands in stark contrast to the tentative probing of false breakouts. It's like comparing someone testing the water with their toe versus someone diving in head first. That difference in commitment tells you everything about what's really happening beneath the surface. It reveals the mindset of the players moving the stock. Are they uncertain and speculative, or are they confident and determined? But here's where the market's psychological dimension becomes truly fascinating. There's a carefully orchestrated dance happening that most retail traders never recognize. The market deliberately creates an environment of fear and urgency, what we now call FOMO, fear of missing out. This emotional trigger causes the crowd to rush in prematurely, buying at exactly the wrong moment. Then comes the heartbreak. The stock reverses, trapping all those eager buyers who thought they were getting in early. Frustration sets in, positions are liquidated at a loss, and the typical retail trader walks away muttering about manipulation or bad luck. But this isn't random, it's by design. It's the market's filtering mechanism at work. Subscribe now to continue your journey into market psychology with more insights that most traders never discover. What's happening behind the curtain is a deliberate transfer of ownership. Smart money, the institutions, funds, and sophisticated players patiently wait for this cycle to complete. They want the weak hands shaken out. They need the path cleared of emotional traders before they make their real move with full force. The revelation that changed my entire trading journey was understanding that I had a choice. I could continue being part of the emotional crowd that serves as exit liquidity for smart money, or I could align myself with the patient accumulation approach of professional players. It's a complete mindset transformation that few ever make. When you understand this dynamic, you stop seeing the market as a series of independent price bars and start recognizing the narratives being written by institutional footprints. You begin to appreciate the choreographed process of accumulation, distribution, and the shakeout phases that precede genuine moves. I'm curious, have you noticed this pattern of false breakouts clearing out retail traders before the real move begins? Drop smart money patience in the comments if you've observed this sophisticated market dance in your own trading experience. One of the most revealing aspects of Wyckoff's methodology is what happens after a stock breaks above resistance. This post-breakout behavior tells a profound story about the quality and sustainability of the move. It's a moment of truth that most traders completely overlook in their excitement about the initial breakout itself. In a false move, those deceptive head fakes we've all fallen for, the stock typically can't sustain its position above the breakout level. Within days, sometimes hours, it slips back into its previous trading range as if magnetically pulled back to familiar territory. The excitement fades, volume contracts, and the stock returns to its sideways drift, leaving disappointed traders in its wake. But a genuine breakout tells an entirely different story. Even when it pulls back, and most healthy breakouts do retrace somewhat, it refuses to surrender all its gains. Instead, it finds support at or near the previous resistance level, which is now transformed into a floor rather than a ceiling. This price action reveals a fundamental shift in market psychology. What was once considered expensive is now viewed as a bargain. This revelation completely changed my journey as a trader. Instead of abandoning positions at the first sign of pullback, I began watching how stocks behaved after their initial surge. Was the new level being defended? Were buyers stepping in before the stock could retreat to its old range? This simple shift in perspective turned many would-be stopped-out trades into some of my biggest winners. But Wyckoff's genius goes even deeper. While most traders obsessively watch price highs, celebrating each new peak while ignoring everything else, he discovered that the true story of accumulation is often written in the lows. This counterintuitive insight is perhaps the most powerful hidden truth in technical analysis. When a stock makes a series of higher lows during its consolidation phase, it's revealing something profound about the behind-the-scenes activity. Each dip that stops and reverses at a higher level than the previous dip is essentially showing you the footprint of strong hands at work. Someone with deep pockets and conviction is systematically buying every decline, creating an upward-sloping floor beneath the stock. Think about the market wisdom embedded in this observation. While the amateur fixates on when the stock will break out, the professional is quietly watching those rising lows, recognizing the invisible hand of accumulation at work. It's like seeing the foundation being laid before the building even starts to rise. By the time the breakout finally occurs, the professional isn't surprised. They've been watching the preparation for weeks or months. This perspective completely transforms how you evaluate potential opportunities. Rather than chasing stocks making new highs, you begin looking for those creating stair-step patterns on their lows, each decline stopping at a higher level than before. This pattern of rising support reveals stocks under professional accumulation before the crowd has any idea what's happening. I'm curious if you've ever noticed this pattern of higher lows before a major breakout in your own trading. Drop "rising floor spotted" in the comments if you've seen this subtle but powerful signal at work in the markets. This concept of rising floors, creating a staircase pattern, is one of Wyckoff's most powerful visual metaphors. Imagine climbing a ladder. Each rung you step on becomes a new level of support. Beneath you, in the market, when a stock repeatedly finds support at progressively higher levels during pullbacks, it's revealing a profound truth about what's happening beneath the surface. This staircase pattern doesn't happen by accident. It's the direct result of deliberate action by what Wyckoff called strong hands, sophisticated investors with both the capital and conviction to accumulate meaningful positions. These players aren't looking for quick flips or minor profits. They're building substantial positions with a longer-term perspective that reflects deep confidence in where the stock is headed. What makes this revelation so transformative is understanding the mechanics behind it. When a stock dips, most retail traders experience fear. They see the decline and worry about further drops. This emotional response triggers selling. But someone on the other side is buying everything being sold, and not just passively. They're aggressively absorbing all available supply before the stock can fall to previous support levels. This dynamic creates what might be the market's most reliable footprint of institutional accumulation. With each progressive dip that stops higher than the last, the smart money is showing you their hand, if you know what to look for. They're essentially drawing a line in the sand that keeps moving higher, saying, "We won't let the stock fall below this level anymore." Behind these rising floors lies a fascinating psychological journey that few retail traders ever recognize. What you're witnessing is nothing less than a methodical transfer of ownership from weak, emotional hands to strong, conviction-based investors. Each dip represents a test, a moment of truth where holders must decide if they believe enough to keep holding or if fear will drive them to sell. When weak hands sell during these dips, they're unknowingly participating in a wealth transfer mechanism as old as markets themselves. Their shares aren't disappearing into a void. They're being systematically accumulated by those with deeper pockets and clearer vision. With each round of this process, ownership becomes more concentrated in strong hands, creating what Wyckoff described as tightening the spring. This concentration of ownership in confident hands is precisely what creates the conditions for powerful breakouts. As supply dwindles and demand remains constant or increases, the stock becomes increasingly pressurized, like a spring being compressed tighter and tighter. Eventually, the slightest catalyst can release this stored energy in a dramatic upward move that catches most traders by surprise. Understanding this dynamic completely reshapes how you view market behavior. Those seemingly random price fluctuations transform into a coherent narrative of accumulation and distribution. The market becomes less mysterious and more logical, a battlefield where patient capital systematically outmaneuvers emotional money time and again. Have you ever watched a stock you own go through this process, creating those higher floors with each dip? Type "wealth transfer" witnessed in the comments if you've seen this fascinating psychological dynamic play out in your own portfolio. Another subtle but powerful revelation in Wyckoff's methodology is how the speed of rebounds tells a profound story about market strength. In weak stocks, those lacking institutional support, declines tend to linger. The price drifts lower and stays depressed because there's simply no urgent buying interest. It's like watching a ball bounce with less and less energy until it finally stops moving altogether. But in stocks under accumulation by smart money, the behavior during pullbacks is dramatically different. The declines are short-lived, almost impatient in their brevity. The stock barely has time to dip before strong hands step in and aggressively bid it back up. This immediate response to weakness reveals something critical happening behind the scenes. Someone with substantial resources is determined not to let the stock fall too far. This urgency in buying dips isn't the behavior of scattered retail traders. It's the deliberate action of players with size and conviction who recognize the value proposition and aren't willing to risk missing out on additional shares. They've done their homework, they have a clear thesis, and they're systematically building positions with the kind of patient aggression that defines professional accumulation. The contrast in these bounce patterns creates one of the clearest dividing lines between stocks poised for significant moves and those likely to remain stagnant. A stock that takes days or weeks to recover from dips is showing you the absence of committed buyers, but one that snaps back within hours or even minutes is revealing the invisible hand of institutional interest at work. Perhaps the most valuable insight you can have as a market participant. This behavioral pattern ties directly into what might be Wyckoff's most profound market revelation, the consistent lateness of the crowd. There's an almost tragic predictability to how retail investors perpetually arrive after the real opportunity has passed. They don't recognize the accumulation process while it's happening. They miss the rising floors, the quick rebounds, the tightening price action that signals something important building beneath the surface. Instead, the crowd waits for the obvious, the headline making, breakout, the analyst upgrade, the feature story that everyone's talking about. By the time these catalysts emerge, smart money has already established their positions at far lower prices. The painful truth is that when the average investor is finally convinced enough to buy, they're unknowingly providing the exit liquidity for early positioned professionals. This timing disconnect explains why market participation feels so frustrating for most people. They experience a perpetual cycle of buying high and selling low because they're operating on entirely different cues than the professionals. While amateurs wait for confirmation and comfort, professionals act on subtle evidence of accumulation that precedes the obvious breakout. The difference between fortune and frustration in the market often comes down to this single factor. Are you positioned before the crowd awakens to the opportunity, or are you part of the crowd rushing in after the easy money has already been made? This recognition forces a fundamental reassessment of how most people approach trading and investing. If you've ever found yourself buying a stock after it's already made a substantial move, only to watch it stall or reverse shortly after you enter, drop late to the party in the comments. This timing challenge might be the most universal experience in market participation. Wyckoff's approach to spotting strength before it becomes obvious to the crowd is perhaps the most valuable skill any market participant can develop. It's a perceptual shift that transforms how you view price action, allowing you to see beyond the surface-level movements to the intentions being telegraphed by smart money. A stock under genuine accumulation develops a unique personality that sets it apart from the thousands of others in the market. This distinctive character reveals itself through subtle behavioral patterns long before the headline-grabbing breakout occurs. It's as if the stock is quietly whispering its intentions to anyone patient enough to listen. These whispers appear in how the stock handles adversity. When the broader market declines, a strong stock refuses to follow suit or falls much less than its peers. When sector weakness hits, it shows remarkable resilience, quickly bouncing back while others continue to struggle. During flat market periods, it finds ways to creep steadily higher, defying the gravitational pull of the overall environment. Perhaps most revealing are the volume signatures that accompany these behaviors. You'll notice unusual spikes in buying activity during quiet periods, as if someone is systematically accumulating shares when no one is looking. These volume anomalies often occur without any news catalyst, a clear fingerprint of deliberate institutional buying that most retail traders completely overlook. This combination of relative strength, resilience during weakness, and strategic volume patterns creates a mosaic of evidence pointing to behind-the-scenes accumulation. The stock is essentially telegraphing its future intentions through these behavioral tells, long before the breakout that will eventually catch the crowd's attention. But here's where many traders make a critical mistake in their journey. They confuse early entry with blind guessing or gambling. They jump into stocks without evidence, hoping to catch the beginning of a move through luck rather than analysis. This approach inevitably leads to disappointment and frustration. True early entry, as Wyckoff defined it, is never about gambling. It's about recognizing a specific constellation of evidence that points to professional accumulation. Rising support levels creating that staircase pattern we discussed, expanding volume on up days but contracting volume on down days, quick recoveries from market-wide weakness, and the stock's general refusal to stay down when hit with selling pressure. This approach represents a fundamental mindset shift from how most people engage with markets. Rather than chasing excitement or following tips, you're methodically identifying stocks, showing the footprints of smart money positioning before the obvious breakout. You're essentially aligning yourself with the same forces that consistently transfer wealth from emotional retail traders to disciplined institutional investors. Being early means having the courage to establish positions during quiet periods when nothing exciting seems to be happening. When there's no cheerleading, no social media buzz, no analyst upgrades. This psychological dimension requires both foresight to recognize the accumulation signals and discipline to act on them, despite the lack of external validation. The revelation that transformed my own trading journey was understanding that true edge in markets doesn't come from having special information or sophisticated systems. It comes from having the perception to spot institutional footprints and the patience to position alongside them before the crowd awakens. Have you experienced this kind of aha moment in your own market approach? Type "seeing the invisible" in the comments if you've had glimpses of this deeper market reality. As we've explored Wyckoff's timeless insights together, I hope you're beginning to see the market through a different lens. These patterns of accumulation and distribution aren't just historical curiosities. They're playing out on your screens every single day, speaking a language most traders never learn to interpret. The journey from being part of the emotional crowd to aligning with smart money isn't just about better trading results. It's about a fundamental transformation in how you perceive market behavior. When you start recognizing those rising floors, those quick rebounds, those subtle volume signatures that telegraph institutional intent, you experience markets in an entirely new dimension. What fascinated me most when I first discovered Wyckoff's methodology was how it turned trading from a series of random guesses into a coherent narrative I could actually follow. Suddenly, those mysterious price movements had meaning. They were telling a story about the transfer of ownership from weak hands to strong, from the impatient to the disciplined. This perspective has guided my own market approach for years now, and I'm genuinely excited to share these insights with this community of serious traders and investors. If you found value in these ideas today, I'd appreciate your support with a like on this video. It helps these concepts reach others who might benefit from them. I'd also love to hear which of these signals you've noticed in your own trading journey. Drop Wyckoff Wisdom in the comments if you made it to the end and plan to watch for these patterns in your charts going forward. If you're not already part of our community, consider subscribing for more content that goes beyond the surface-level analysis you find elsewhere. We focus on the deeper patterns that actually drive market behavior, the kind professional traders use every day. There's a video right here that explores how to manage your positions once you've spotted these early breakout signals. Click and continue with me there to complete the picture of how to capitalize on these opportunities once you've identified them.